That's actually a piece of wisdom many long term investors agree with. The idea is that the economy and the stock market don't always move in sync. The economy reflects what's happening now: growth, inflation, jobs, etc. The stock market is forward looking, pricing in what investors expect to happen 6 to 12 months ahead. If you wait for the economy to look good before investing, you'll usually miss the best opportunities. Because by then, the market has already priced in the recovery. That's why many successful investors focus on time in the market, staying invested for the long run, rather than trying to time based on the economy. Company fundamentals, profits, balance sheets, long term trends, diversification to handle the ups and downs no matter where the economy is. Do you want me to give you a simple example of how ignoring the economy would have helped an investor in the past? Great, let's take the 2008 financial crisis as an example. The economy in 2008 to 2009. Banks were collapsing. Unemployment was skyrocketing. Housing prices were crashing. News headlines were all doom and gloom. What most people thought: this is the worst time to invest. The economy is broken. Many stayed out of the stock market, waiting for better economic times. What actually happened? The S&P 500 US stock index hit bottom in March 2009. From that point, over the next 10 years, it rose by more than 300%. The economy itself didn't feel good until years later, but the market had already surged. Lesson: if you waited for the economy to look strong, you would have missed one of the greatest buying opportunities in modern history. The takeaway: markets recover before the economy does. That's why focusing on long term investing and ignoring short term economic noise is often smarter. Do you want me to give you a modern day example, like post COVID 2020? Perfect. Let's look at COVID-19 in 2020. The economy in March April 2020. Lockdowns everywhere. Unemployment shot up to record levels. Airlines, hotels, restaurants basically shut down. Headlines: global recession and the worst crisis since the Great Depression. What most people thought: the economy is collapsing, stocks will keep falling. Many sold their investments or stayed in cash. What actually happened? The S&P 500 dropped 34% in February-March 2020. Then, while the economy was still closed, the stock market began recovering in late March 2020. By August 2020, the market had already hit new all-time highs, months before vaccines, job recovery, or normal travel. Over the next 2 years, it delivered huge gains. Lesson: if you ignored the scary economy and just invested or stayed invested, you would have made massive profits. If you waited for economic recovery, you would have missed the fastest rebound in stock market history. In both 2009 and 2020, the pattern is the same. The market recovers first. The economy catches up later. Do you want me to explain a simple rule of thumb you can follow so you don't fall into the waiting for the economy trap? All right, here's a simple rule of thumb many smart investors follow to avoid the waiting for the economy trap. The three rules for long term investing: 1. Invest regularly, ignore the noise. Put money in the market on a consistent basis, monthly, quarterly. This is called dollar cost averaging. It smooths out ups and downs. You don't need to predict the economy, you just keep building your position. 2. Focus on time in the market, not timing. Missing just the 10 best days in the stock market over 20 years can cut your returns in half. Being invested through the ups and downs is more profitable than trying to jump in and out based on news. 3. Own quality plus diversify. Choose strong companies, index funds, or ETFs. Diversify across sectors: tech, healthcare, finance, energy, etc., and geographies. That way, no single economic event can ruin your entire portfolio. The mindset shift: instead of asking, is the economy doing well right now? Ask, am I investing in assets that will be worth more in 5 to 10 years?